Markets now. Russ Mould joins me from London. He is Investment Director at AJ Bell. Thank you very much indeed for speaking to us, Russ.
Pleasure, Robin.
So the UK released some very strong employment data. What effect might that have on the economy?
Well, I think it's a reflection of the fact that the economy is doing reasonably well. We heard from Chancellor Hammond last week. He gave the Office for Budget Responsibility's latest growth forecasts. They're OK, 1.4, 1.5, 1.6%. So nothing too disastrous, nothing too exciting. But I think the good news is that finally, very low unemployment, as you said, a 44-year low in jobless rate, is finally feeding into wage growth. So wages are now up by nearly 3.5% year on year. That's much faster than inflation, which has gone below 2%. That's putting more money in consumers' pockets in real terms, and it may mean that consumer spending finally starts to pick up with some possible benefit to the wider economy.
And it does raise the prospect of future rate rises, and the MPC is actually meeting this week. What do you expect to come out of that?
Well, I think nobody's expecting the Bank of England to do anything ahead of what could be Brexit Day on the 29th of March, and Bank of England Governor Mark Carney is still playing very cautiously. He still seems to argue that Brexit could be a bad thing for the British economy, at least in the short term. So nobody's expecting anything from the Bank of England, but you're quite right. Normally, accelerating wage growth would mean higher interest rates. If we get some sort of tangible Brexit deal, maybe the Bank of England will put through a second interest rate increase for this cycle in the second half of the year, but I personally wouldn't be holding my breath.
Well, you mentioned the B word, Brexit. We had some more uncertainty yesterday following what the Speaker said in the UK Parliament. How did the markets react to that in the UK and in Europe?
They seem to have taken it in their stride. Sterling has gained a little bit against the euro and the dollar today. It's trading near its year highs against both currencies. And the FTSE 100, the UK's major stock market index, is up by around 1/3%. That's now at its highest level since October. So it seems to have been interpreted, the Speaker of the House's intervention, that we may still avoid a no-deal Brexit, that there could be a delay, and that therefore there will be a sensible transition. Equally, people who are all in favour of leaving with as hard a Brexit as possible, they still think this plays to their advantage because it means that Mrs May's deal is not going to be passed through the House of Commons. So Remainers and Leavers both seem to think that the Speaker's intervention is good for them. They can't both be right, but at the moment the stock market seems to think it means a delay or a soft Brexit. We'll see whether it's right or not.
And let's lastly talk about one share that was doing particularly well on the FTSE today, and that was Antofagasta.
Yeah, giant copper miner. Its assets are in Chile, but its shares are traded in London. Its full-year results themselves were nothing special. Sales and profits slightly down, thanks to a fall in the copper price last year. But the copper price has moved up around 10% from its lows so far this year. The company's looking to expand production at a big mine with a $2.5 billion investment program, and that, coupled with a higher dividend, has gone down quite well. So the shares are up around 3%. It's interesting to hear Antofagasta predict a tight balance between supply and demand for copper this year. Normally, Dr. Copper is used as a good measure of the health of the global economy because it's used in so many things from cars to housing. And so when copper prices are firm, normally a good sign for the economy. So let's hope that it proves to be the case for 2019 as well. OK,
Russ Mould, Investment Director at AJ Bell, thanks very much for speaking to us.
Thank you, Robin.
Now to other top stories from around the world. Shares in Asos fell 13% after the online fashion retailer missed second quarter forecasts due to a slowdown in its US business, as well as sluggish growth in the UK and Europe. The London-based company reported an 11% rise in total retail sales to $850 million in the quarter, below its 15% revised target for the year. Korean carmaker Hyundai is investing $300 million in Indian ride-hailing app